Morning from Vienna. We are very happy about the first 9 months of this year. We have been driving our profits from the top line. Net interest income, as you just mentioned, has been very strong. But what is also very important to us, that the fee income, which is also a strategic goal for us to improve it, has been doing very well. So we are very optimistic for the year end. Also see some good developments into 2024 with loan growth returning.
Yeah, it's my job to try and pick holes in all this, but I'm just looking at your return on equity, for instance, which has gone up in the third quarter to 17.7%, albeit lower than the second quarter, but way higher than what we saw 12 months ago. Just tell us a little bit about the returns on your return on equity, return on tangible equity.
Yeah, we will most likely achieve comfortably our target for 2023, which is significantly north of 15%, in order to beat our cost of equity with a margin. And now looking into 2024, which of course is going to be this difficult year from the macro environment still, we are expecting to be able to deliver around 15% return on tangible equity again, which I think is a very, very positive outlook, which we also want to communicate today to the market in our analyst call.
Can I ask you about the net interest margin? This is where we've seen slippage across the board from a lot of banks posting numbers in the past week, a lot of those being UK banks. But at 2.5%, is this the high watermark when it comes to the NIM?
Very likely so. I do agree. We see some margin compression here and there, of course, from repricing of the deposit base. Nothing unexpected. We believe that loan growth will return into our region, which will then drive the NII like maybe in the years before the rate increases. So yes, net interest margin might be peaking here.
Can I ask you too about what we're seeing on the expenses side here, and just looking at the numbers, and does feel as though you've been trying to strip expenses out of the business, but where do you go to from here on those expenses?
Yeah, expenses have been rising, absolutely clear, on the back of very strong inflation, but also on the back of a very tight labor market, which in other aspects is very supportive to our business model. We expect still 2024 to have elevated overall inflation levels, and especially also some wage inflation to come across. Still, 2024 will be the year of overall reduced inflation compared to this year. So in other words, we also have to manage it as a part of our business model to cover those expense rises, and we are optimistic that we will be able to do so.
Stefan, look, your shares year to date are up 9.3%. I know a lot of people come on, they don't want to talk about the shares, but the truth of the matter is, you're still only trading at 0.64 price to book. You're trading at a PE ratio of only 5 times forward as well. Despite the fact you've got a near 6% dividend yield as well, what is it when you have those conversations and your CEO has the conversations with your investors? What is it they're saying that's stopping them from re-rating this stock to the upside?
Well, first of all, I think our dividend yield is even higher, since we have been increasing our dividend proposal for 2023. But you're absolutely right. The banking sector in general is trading mostly below book, is trading at very, very low price earnings. We believe we can only deliver very good results. We can show that our business model is strong, and that we can also deliver future results. And then I'm sure that the share price will adapt sooner or later.
Can I ask you about